In this week's video, we'll review the latest charts and data to help us make a logical comparison of the 2022 peaking process and 2025. In last week's video, we reviewed the charts in the context of recent market volatility and said, using numerous charts, including this one dated October 10th, that we really hadn't seen anything yet that was overly concerning. If we fast forward to the close on Friday, October 17th, and review a weekly chart, we can see in the upper right-hand corner of your screen over here that the S&P 500 was up 1.7% for the week, and XLK was up 2.38% for the week. Having said that, if we zoom in on the S&P 500 using a 39-minute chart, we can see the rally attempt off of the recent low here has some work to do. We really like to see the market get out into this white space out here prior to making any aggressive moves with new cash. Shorter term, it was a good sign during Friday's session before lunch. You can see the VIX here was red. That told us to be open to an intraday rally attempt. And by the close, the Dow, the S&P 500, and the NASDAQ were able to finish green. And you can see the NASDAQ and the S&P finished up over 0.5%, same for the Dow, and the VIX ended up being down almost 18% near today's close. Using the daily chart on your screen dated Friday, October 17th, again as of the close, you can see we really don't have a lot of damage even to the shorter term trend at this point. You can see the market here made a stand near a rising 50-day moving average. That's the dotted blue line here. And as we discussed last week, has numerous reference points below that tell us this rally attempt off of the April low when the tariff news became less bad is still intact. And our goal is to stay with this trend as long as it's in force. If we apply those exact same reference points that we used in the prior chart for the S&P 500, the chart of XLK, the technology sector ETF for the S&P 500, you can see the short-term trend is still so strong that we really haven't even come back near that upward sloping 50-day moving average, the dotted blue line here. This is the look of the chart since the February 2025 high over here. That's the left side of your screen. If we look at the same chart, but now we zoom in as of the April low here when the tariff news became less bad, that's the lower left-hand corner of your screen. You can see if the market decides to backtrack, if tech continues to weaken relative to this peak up here, this region in here, this is a band that could represent potentially strong support. So it's easy to remain patient even if the volatility continues. We know that even the strongest trends have 100% normal and to be expected givebacks and drawdowns. Should XLK and the S&P 500 decide to weaken further, these type of charts will help us determine the health and strength of the existing trends. Our regional banks were the source of all the volatility during Thursday's session. And you can see KRE, the S&P Regional Banking ETF, remains relatively healthy. Closed Friday around $59 a share. It could fall all the way to 49-ish down here into this band without doing much damage to this uptrend that started back in 2023 back here. And while this is a volatile chart, you can see since the 2020 low here, it has been moving from the lower left to the upper right for the most part. And that's important because KRE is relatively weak and its chart in isolation still looks pretty good and has some room to weaken further, allowing us to be patient. If we look at KRE regional banks relative to the S&P 500 index, you can see it is moving from the upper left to the lower right. That's the type of situation that we would prefer to avoid, which is why we haven't been anywhere near regional banks for quite some time. This chart helps us understand how we should allocate our capital. Some charts help us with the question, should we be in stocks? This chart helps us with where should we put the money. A lot of talk this year, and rightly so, about foreign stocks. This is January 2025. They came out of the gate very, very quickly. But that ended here in April when the tariff news became less bad. It's pretty clear to see the long-term trend for foreign stocks, ACWX, relative to XLK, the technology sector for the S&P 500. That trend hasn't flipped in any meaningful way. And it still remains clearly in a long-term downtrend. And if you're playing a long-term trend game, which we are in the context of a secular bull market, we would prefer to ignore what are so far counter-trend rallies of outperformance for foreign stocks within the context of existing downtrend of long-term underperformance. If this ratio can get out into this region here and these lines can flatten out, the colored lines, and turn up, then our assessment of the probabilities would change. And that absolutely positively may happen very, very soon. But as you can see, it hasn't happened yet. Everything that we said about the last chart applies to this chart as well. This is small caps IWM in the ETF world relative to XLK tech. How about gold? We have a position in gold. It's done extremely well. I believe we have two major block trade buys, and I think both of them have doubled. Having said that, in terms of earning a greater allocation in our portfolio, we need to see more relative to this longer-term trend. There's a peak here in the ratio of gold GLD relative to SPY in 2011. You can see these lines are starting to flatten out a little bit. This slope isn't as steep as it was over here. You can see this rally attempt. You can see at this point there's a lot of selling pressure in here. Same thing, a lot of selling pressure here. We had something very, very similar earlier in 2025, but now this looks different. This looks better here relative to this and this. Still has a lot of work to do and a lot of hurdles to cross. Ultimately, what this tells you is from a cost basis or average share price or average ratio price perspective, there's work to be done before market participants are confident that GLD is a better place to be relative to SPY long term. Since this low in 2022, GLD has been a better place to be. But we could have said the same thing from this low here in 2018 to this peak in 2020. We're not rooting for or against gold. We're happy to add to our position. There are numerous charts that we're looking at on numerous time frames. And if this chart flips, we are ready, willing, and able to up our allocation. Everything that we just said about GLD relative to SPY also applies to SLV, silver, physical silver, relative to the S&P 500. What once acted as resistance in 2013, what once acted as resistance in 2016, what once acted as resistance in 2020, may, with the emphasis on may now act as resistance in October of 2025. Silver in isolation looks great. Gold in isolation looks great in terms of the long-term trend. With one exception, both charts have been nearly parabolic, and they're extended at the moment, telling us that it is possible that this ratio will take a break for a while. We'll see how it unfolds. You also hear a lot of talk that gold has replaced Bitcoin. Not sure that the chart on your screen really agrees with that at this point. The long-term trend in GLD relative to GBTC remains down. The last thing it did in late 2024 was make a new lower low. A good and impressive first step would be to get into this region here. A very impressive step would be to clear this region here. A lot of sideways movement in here. And what does that tell you? From a very long-term perspective, if you own Bitcoin and gold, there's really no major clear advantage in this box. You're probably better off holding both and not overtrading them. If we break out of this box to the upside, That would make gold obviously a lot more attractive relative to GBTC. But as we all know, we trade the chart in front of us. This is the chart in front of us as of close on Friday, October 17th. And if you look at gold in isolation, this is a ratio chart. Sentiment is also starting to get very, very extended. You can pause your video player and read the tweet. Here's the source of the tweet. Another study from the same source right here. Here's the website. Got to give credit where credit is due. Gold was up for 9 weeks in a row. And you can see historically that's extremely rare. And at least as far as history goes, it's really overdue for some type of breather. You can see the chart here. It's nearly parabolic. That type of trend we all know can't last. That doesn't mean it's time to get rid of our gold. Gold is volatile, and if you're going to ride what is still a long-term uptrend, you have to be willing to withstand the volatility. We all know that we like to trade charts that move from the lower left to the upper right. Now, that's still what's happening with XLK Tech relative to SPY. That looks a lot different relative to small caps versus the S&P 500, regional banks versus the S&P 500, or foreign stocks relative to the S&P 500. All of those charts from a long-term perspective are still moving from the upper left to the lower right. And this ratio held near a logical area here when the tariff news became less bad. Earlier this year, concerns would increase about tech relative to the S&P 500 if the ratio moved into this white space down here. The longer it stayed there, the more concerning it would become. But the last thing this ratio did was make a new all-time high above this high here. And if you draw a horizontal line here, we made a stand, a logical area again earlier in 2025. But in the short run, this is another chart. If you own XLK and SPY, and we do, there's really no clear advantage shorter term going back to this area here in October of 2023 relative to the present day. They're both doing well, and they both look good in isolation. The attractiveness of XLK relative to SPY looks like it's trying to improve if we can get a breakout similar to this breakout here. And after that, the outperformance lasted several months longer. Key takeaway is this isn't an uptrend. This is what a downtrend looks like. This is what an uptrend looks like. Now, we know that we have a lot of signals in our back pocket, signals that we covered in the September 12th video and signals that we covered in the September 19th video that tell us to keep an open mind about much better than expected outcomes, looking out between 1 and 5 years in both the NASDAQ and the S&P 500. And we also know that in the context of a secular bull market, our goal is to keep our fear about 100% normal and to be expected volatility in check, as long as the data and the charts and asset class behavior tell us the odds favor us remaining in a secular bull market, because our primary goal is to navigate between a point A and a point B that could be several years down the road, a point A and a point B that could be several years down the road. And in our approach, we want to hold and own the long-term leaders as long as we can. And if that leadership shifts, then we want to make the necessary adjustments. The ultimate goal is to make money. And typically, in this type of environment, if you hold the long-term leaders, continually monitor the long-term leaders, while being willing to shift if that leadership changes, you will most likely be rewarded for being patient in the context of a secular bull market. But since we're not making any assumptions, and we know that 50% drawdowns are more common than most people think, and nobody wants to see their $1 million turn into $464,000 hypothetically, we want to make sure that we don't get complacent about the secular bull market. So now we're going to cover the peaking process in 2021 and 2022. If you know your stock market history, You know, the S&P 500 peaked on January 3rd, 2022, and then had a significant drawdown in 2022. And this week, we had a credit scare with the regional banks. So it's logical to look at a riskier corner of the credit market. Junk bonds, JNK in the ETF world. This is a daily chart. Left side of your screen is 2021. The right side of your screen is the bear market low in October of 2022. And you can see over here, JNK has a full bore bullish look with blue, the fastest moving average, the 20-day on top, black, the slowest moving average on the bottom. The slopes of the MAs are up and prices above all of the MAs. And you can see over time, it flips. This is almost the polar opposite over here. This is your point of indecisiveness. So you can see this market is vulnerable in here and indecisive, but it hasn't rolled over yet. And then the credit market rolled over very, very hard, just as the stock market did. So this look here in January of 2022 confirmed the breakdown in the S&P 500. So this would be the type of rollover look that we would want to avoid. You can see the tight cluster of the moving averages here. When you get these tight clusters, you can get big moves. So when it's tight here, you don't know which way it's going to move. But when it starts to take on this look, that's not a good look. So the logical question in October of 2025 is, how does the exact same chart look today? The answer is much, much better. The chart, for the most part, remains in a full-bore bullish look. Had some deterioration in here, but blue, the fastest moving average, is still on top, upper right-hand corner of your screen. Black, the slowest moving average, is on the bottom. The slopes are almost all up. The fastest one's rolling over, but you get the idea. This is still the look of a strong trend, and maybe even a relatively early stage trend because of this tightness in here. Very, very similar to this rollover look here. If the present day chart morphs into something more like this, where you see the 20-day on the bottom of the MA stack and price below all of the moving averages, and that's what we had in late January, early February 2022, concerns would increase. But on October 17th, 2025, that's not what we have. Now let's look at a ratio. Let's look at consumer discretionary versus consumer staples. So we're really kind of looking at, let's say, economically risk on versus economically defensive or risk off. XLY relative to XLP. The S&P 500, again, didn't peak until January 3rd of 2022. You can see this ratio peaks in November. And when we get into January, the fastest moving average is already on the bottom of the stack. That looks quite a bit different relative to the look in Q1 of 2021 over here. There's nothing magical about any of these charts. We're using a weight of the evidence approach. But if we see deterioration, at a minimum, it tells us to pay closer attention. So how does this ratio look today? Is it starting to morph into something more concerning like Q1 of 2022? Not yet. In fact, the last thing the exact same ratio did as of the close on October 17, 2025, was make a new all-time high up here. And you can see the uptrend that began soon after the bear market ended. This is January of 2023. This is a bullish period for the S&P 500, bottom of the screen. This is the S&P down here. The trend off that low is still intact, and right now we have blue, the fastest moving average, on top. Now let's flip it around. Let's look at risk off versus risk on. This is SP low volatility versus SP high beta. So let's just say low volatility or more defensive stocks relative to higher beta or higher volatility or economically sensitive stocks. So this is a defensive ratio. When this ratio is rising, it's not good for the S&P 500. Look at the cluster in here, this tight cluster, telling us a big move could be coming in either direction, and then it breaks this way, which is not good for the stock market, as you can see. And this tells you psychologically that market participants are getting more defensive. they're more comfortable or have greater conviction owning low beta alternatives relative to high beta alternatives. You can see the indecisiveness in this ratio here before the S&P 500 peaked in January of 2022. So the question becomes, do we have something similar evolving on this ratio in 2025? Is it starting to turn up a defensive ratio telling us that we should be concerned about the stock market? The answer is no. The defensive ratio is still hovering around a new 52-week low, and instead of having blue, the fastest moving average on top, as we did in January of 2022 and throughout this entire period, in October of 2025, blue, the fastest moving average for the exact same ratio, is on the bottom. And the long-term moving average, the 250-day in black, is rolling over in a bearish manner for a defensive ratio. Look at the slope of the black line here and contrast it with the flattish turning up look that we had in calendar year 2022. This really doesn't look anything like this. So I don't really have anything in hand that puts any of this in doubt, nor anything that's putting the secular bull market in doubt. You can pause your video player. We did get some incrementally better news on the deficit. At least there's some type of focus on trying to reel in what are borderline insane deficits by governments all over the world. Fundamentally, the big picture still looks pretty good. And technically, as we've discussed, when you're using a weight of the evidence approach, the longer-term trends remain intact for now. If data like this starts to flip in a concerning manner, then our assessment of the probabilities would have to change. We still have talks on the books for late October, early November that are supposed to take place between the United States and China. Wouldn't be shocking if some additional volatility comes our way. And if you're a stock market bull, that might actually be a good thing from a long-term perspective. You really don't want the chart of the S&P 500 to get parabolic like this, because something like that is most likely going to experience some type of relatively painful give back. But that's not a prediction in any shape, form, or fashion. Common sense tells us that the slope of this line up here, for the most part, has to come back down to earth at some point. So if gold and or the stock market digest some of their gains and really don't go anywhere or tread water or have some type of give back, that might actually be healthy for the uptrend. We've got plenty of reference points below, and everything that we still have in hand today tells us not to be overly fearful about making mistakes. And the data, weight of the evidence, tells us still looks like it's prudent to accept and endure 100% normal and to be expected drawdowns that occur even within the context of a longer-term secular bull market, one that potentially could have several years to run. And we all know, if the secular bull market flips into something that looks more like a secular period of stagnation, the only way that we're going to be able to use all of this effectively and effectively migrate to a more defensive and more diversified portfolio is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.